Welcome to The Deep Dive, the show that cuts through the noise and gets you straight to the essential insights. Today, we're plunging into a story that could, well, genuinely reshape how we approach public health. Imagine a world where a single annual injection could truly change seasonal flu prevention, making it almost an afterthought. We're talking about Cidara Therapeutics, ticker CDTX, and the pivotal news today: the overwhelmingly positive results from their Phase 2b Navigate clinical trial.
That's right. And this isn't just about another stock surging on news.
Yeah.
It's about understanding why these results are so profoundly significant. We're going to explore what this means for Cidara's future, the groundbreaking technology behind it, and the potential wider impact on global public health.
Right. Our mission today is to unearth the most important nuggets of knowledge from the sources we've gathered on CDTX. We want to give you the full picture, from the core business fundamentals and financial health to market sentiment, ownership structure, and crucially, the key risks involved. And while you're listening, remember to like and subscribe to Stock Analytics AI. Our 4.99-month members get priority deep dives on specific tickers. And here's a tip for you. Over the next few months, we're covering all of the S&P 500 stocks, and members get exclusive priority access to those deep dives. All right, let's kick things off with Chapter 1, Business Understanding, Cidara Therapeutics, Inc., or CDTX. It's a clinical stage biotechnology company, trades on NASDAQ. Our analysis date is June 23, 2025, and this morning, wow, the stock experienced a significant pre-market surge. It closed at $21.31 on June 20th, but today, June 23rd, it jumped pretty quickly to $22.67. That's a 4.54% move directly linked to those Navigate trial results. So what exactly is driving all this excitement around Cidara?
Well, at its core, Cidara's business model is built around developing and commercializing a new class of medicines called drug-ST conjugates, DFCs. They do this through their proprietary CloudBreak platform. Think of it like this. They're attaching a potent drug directly to a special part of an antibody that's the fbu bit.
Okay.
And this isn't just a clever name. This little innovation is, well, ingenious, because it allows the drug to stay active in your system for much, much longer. It also might engage your immune system in unique ways, potentially lasting a whole season.
Interesting.
What's really fascinating here is their strategic pivot back in 2024. They shifted from being primarily a licensor, lower risk, partner out your drugs, to a vertically integrated biopharmaceutical company.
Right.
And that happened after they took the bold step of reacquiring full global rights to their lead candidate, CD388, from Janssen. Now, that was a bold move because it significantly increased their risk, but, well, also their potential reward.
That's a critical distinction, yeah. And speaking of CD388, you've called it the crown jewel asset.
Yeah.
Can you walk us through what it is and maybe critically why it's so important to distinguish it from a traditional vaccine?
Yeah, that's a key question. So CD388 is a long-acting antiviral DFC. It's designed for the universal prevention of both influenza A and B. And you're right, it's vital to understand this. It is not a vaccine.
Okay.
Instead, it's what we call passive immunization. This means it directly inhibits the virus from proliferating in your body.
No.
And it works independently of your own immune system. So it doesn't need to train your immune system to fight. It provides an immediate kind of external shield
Ah, I see.
that makes it potentially incredibly valuable for populations who don't respond well to traditional vaccines. Think elderly, immunocompromised people. And yes, the goal is a single seasonal injection.
That truly sounds like a potential game changer, especially for those high-risk groups. And they're targeting a massive market, aren't they? I mean, the U.S. influenza market alone was, what, $3.6 billion in 2021? Projected to grow at like 8.5% compound annual growth rate through 2032. Plus, post-COVID, everyone's much more aware of this stuff, right? More investment in prevention.
Absolutely. Heightened awareness, more investment. The competitive landscape for flu is intense, though. Lots of major players. Existing antivirals like Tamiflu and Xofluza, they're mostly for treatment. You take them after you get sick.
Right, treatment.
CD388 is aiming for prevention, long-acting prophylaxis. Now, direct pipeline competitors include Vir Biotechnology GSK with VIR-2482, that's an AB. Moderna's got their mRNA 1010 vaccine, and SAB Biotherapeutics has SAB-176, a polyclonal antibody.
Okay, so other players are trying preventative too.
So they are, but here's where CD388 seems to really shine. It's unprecedented efficacy, that's 76.1% prevention efficacy, and it's clean safety data from the Navigate trial.
Well, that sets a really high bar.
76%. Yeah. I mean, think about typical flu vaccines. They vary wildly, right? Often 40–60% efficacy, maybe, in a good year. Getting 76% prevention with just one injection, that's exceptional. And it distinguishes itself through that passive immunity mechanism versus the active immunization you get from vaccines.
That 76.1% efficacy is definitely a standout number. Wow. And it's also worth noting the regulatory side looks good too. FDA granted it Fast Track designation back in June 2023. Can you explain why that designation is such a big deal for a company like Cidara?
Oh, Fast Track is huge. It basically means the FDA recognizes CD388 could address a serious unmet medical need. This designation helps speed up its review process, potentially shaving years off the time it takes to get to market, assuming everything goes well.
Shortens the timeline.
Okay, exactly. And on top of that, you have these formidable barriers to entry in developing novel biologics. They act like a protective moat for Cidara. We're talking strong intellectual property, the CD388 patent, for instance. Prohibitive capital costs for these huge trials. Highly specialized technical and manufacturing expertise.
Yeah, not easy stuff.
Not easy at all. These aren't hurdles new players can just jump over easily. It gives Cidara a significant advantage. Sure, they might lack, public brand strength or traditional cost advantages right now, but those foundational assets, the tech, the IP, the data, those are absolutely key. Now let's move on to Chapter 2. Management evaluation. The leadership team at Cidara seems like a significant strength here. The CEO, Dr. Jeffrey L. Stein, he has a proven track record.
Wow.
He successfully led Cidara Therapeutics, which was eventually acquired by Pharmaceuticals. So he's done this before.
The track record.
Yeah, and what's particularly compelling is the depth of experience across the whole executive team. You've got leaders from top-tier biopharma and government health organizations, Genentech, Roche, BARDA, Gilead, Pfizer, names you recognize. Their chief medical officer, Dr. Nicole DeVarpana, and the SVP of clinical development, Karina Pavetto, seem particularly key in driving the clinical strategy forward.
What really stands out to me about this team, though, is how they handled that crisis back in 2023. When Janssen, their partner at the time, decided to deprioritize its infectious disease pipeline, that must have put CD388 at serious risk, like a real gut punch for Cidara.
How did leadership turn that potential disaster into what you're calling a strategic masterstroke?
Yeah, that's where their vision really came through. I think they didn't just see a setback, they saw a pivotal opportunity. By reacquiring the full global rights for CD388, and it cost them $85 million upfront, which is a lot. For a company their size, they were essentially betting big on their own science, on their belief in the drug.
A huge bet.
A huge bet, exactly. It was definitely risky, but now with these trial results, it looks absolutely brilliant. It kind of highlights a critical lesson, right? Sometimes the biggest opportunities are hidden inside the biggest challenges.
It certainly seems that way here. And speaking of things paying off, their transparency and communication looks like another strength. How does that help build investor confidence, especially in a sector like biotech where things can change so fast?
Yeah.
Well, it's absolutely crucial. They've been very diligent, it seems.
Yeah.
Regular updates, prompt SEC filings, they show up at investor conferences, R&D days. The detailed Navigate data release we're discussing today is a perfect example of that commitment to transparency. And importantly, no ethical red flags have popped up, which is vital for maintaining trust. Public perception can shift so quickly in biotech.
Makes sense. Now, that capital allocation strategy in 2024 was really something. They divested risafungin, their approved antifungal, to really laser focus on the Cloudbreak platform and specifically CD388. At the same time, they paid that $85 million upfront to get CD388 back, and then to fund it all, they raised a hefty $345 million in 2024 through private placements with these top-tier investors. This all-in approach. It was a very calculated gamble, wasn't it?
It really was. A significant gamble, you could say, and right now it looks like it's paying off. Which, brings up an important point for listeners. What about returns for shareholders right now? As a clinical stage biotech, Cidara has really high R&D needs. So they don't pay dividends or do share buybacks. That's typical. It's appropriate for this stage.
Standard practice.
Exactly. Historically, their return on invested capital, the ROIC, it's been deeply negative, like minus 93% or something. But you can't really look at that as poor performance necessarily. The whole investment case here hinges on a massively positive future ROIC if CD388 succeeds. All that spending now is expected to yield substantial future profits if, and it's still an if, the drug makes it to market.
Right. It's all about the future potential. Okay, let's dive into Chapter 3, Financial Analysis. So as of June 20th, 2025, just before this big surge, Cidara's market cap was around $272.6 million. That gives us a baseline for how the market saw them before this Navigate news broke. But when we look at their historical revenue, it's kind of all over the place, isn't it? What does that tell us about their financial state right now?
Yeah, it's interesting that historical revenue, like $64.3 million in 2022, dropping way down to $1.3 million in 2024, it isn't really a good indicator of their current operational progress.
Mm.
That mostly reflects things like collaboration milestone payments and then the strategic end of that Janssen agreement.
Mm.
So today, Cidara is fundamentally a pre-revenue development company,
Pre-revenue, okay.
which means all their profitability margins, gross, operating, net dollar, they're deeply and consistently negative. For instance, Q1 2025, they reported a net loss of $23.5 million on basically zero revenue. Now, again, this isn't necessarily a sign of distress. It's a normal, expected consequence of being an R&D-heavy biotech just pouring money into clinical trials.
Got it. And along those lines, their free cash flow also consistently and significantly negative. I see a nugget $176.7 million in 2024. Is that also just part of the strategic investment phase?
Exactly. That negative free cash flow isn't a sign they're in trouble. It's deliberate strategic investment.
Yeah.
Capital deployment. That figure includes the $85 million they paid to get CD388 back, plus the huge costs for that 5,000-plus patient Navigate trial we've been talking about. It's money being purposefully used to advance their lead asset.
Okay, so despite that negative cash flow, their financial stability actually looks pretty robust on paper. They've got what's described as a pristine balance sheet, effectively no debt, 0% debt to equity, strong liquidity too, current ratio of 3.87. And as of March 31st, 2025, $174.5 million in cash. Why is having basically no debt such a big strength for a company like this, a pre-revenue company?
Oh, it's critical. For a company that isn't generating consistent revenue yet, having no debt means they aren't burdened by interest payments or restrictive loan covenants. It gives them incredible flexibility, control over their strategic decisions, future financing options. It buys them runway, time, and like we said, dividend stability isn't really relevant here. Their focus is 100% on reinvesting every dollar into R&D for future growth.
Makes sense.
So when it comes to valuation, well, traditional metrics like price to earnings, PE ratios, they're not meaningful for Cidara because they consistently lose money right now. The most appropriate method, though it's complex, is probably discounted cash flow, or DCF.
DCF.
Yeah. It involves projecting future cash flows, mainly from potential CD388 sales, and then discounting those projections back to today's value, factoring in time and, importantly, risk.
Okay, so let's walk through some key assumptions you might make in an educational DCF model for Cidara, just for illustration. For the discount rate, maybe a base of 20%, range 18-25%, reflects that high biotech risk, but maybe a bit lower now post-data.
Yeah, 20% baseline seems reasonable, maybe trending lower into the range now.
Okay. Probability of success, phase 3 to approval. Base, 65%, range 50-75%. That's higher than average, right? Because of this phase 2B data.
Definitely higher than the typical 58% industry average. The phase 2B data really helps de-risk it, so 65% seems like a solid base assumption.
Right. Peak market penetration in that high-risk group. Maybe base 20%, range 10-30%.
Seems plausible. It's a new category, but addresses a clear need. 20% feels like a reasonable starting point.
Annual price per treatment, net, around $1,500, range $1,000, $2,000.
Yeah, that's in the ballpark for novel biologics and preventative health. $1,500 net seems like a sensible assumption.
And finally, terminal growth rate after pads expire. Base 0%, range -1% to 1%.
0% is standard conservative assumption for terminal growth in DCS like this.
Okay, so what do these assumptions, just taken together, suggest about Cidara's valuation before the news hit?
Well, what's fascinating is that even using fairly conservative assumptions within those ranges, the output from such a model likely suggested that the pre-announcement stock price didn't fully capture CD388's potential value. And that actually aligns quite well with where Wall Street analyst price targets were sitting. It points towards potential significant long-term upside. It basically means the market maybe hadn't fully priced in the probability of success for this key asset, which transitions us nicely. Let's talk Chapter 4. Market sentiment. Before this Navigate data dropped, Wall Street analyst sentiment was already overwhelmingly positive. You saw strong buy or buy ratings pretty much across the board. Price targets were ranging from $35 up to $50, averaging around $42.
Wow, $42 average target when the stock was at $21. That's nearly 100% upside they were seeing before this news.
Exactly. Firms like Guggenheim, JMP Securities, Needham, RBC Capital, H.C. Wainwright, they were all bullish. The pros were already seeing significant potential here.
And the impact of this actual news, the June 23rd announcement, has been just uniformly positive in the media coverage I've seen. Everyone's highlighting that unprecedented efficacy. It's clearly driven immediate, very favorable market sentiment. Beyond the headlines and analyst ratings, What other market indicators should we look at here?
Well, another key one is short interest. This is interesting. As of May 30th, about 11.51% of Cidara's public float, that's roughly 474,000 shares, were sold short.
So a decent chunk of people betting against it.
Right. A significant number of investors were betting the stock price would go down. Now, what happens when overwhelmingly positive data like this comes out? It likely triggers a short squeeze.
Ah, the squeeze.
Yeah, it can really amplify the stock surge. Those short sellers are suddenly facing big losses, and they're forced to buy shares in the market to cover their positions, to cut their losses. That buying pressure, on top of the positive sentiment, can really drive a stock higher very quickly.
That's a powerful force for sure. And technically speaking, the stock was already looking pretty good, trading above its moving averages.
Yeah, it was already above its 50-day and 200-day simple moving averages, both hovering around $22 to $22.20. Those are generally seen as bullish technical signals. And this positive data is widely expected to just further extend that existing uptrend.
Okay, good context. Moving on to Chapter 5, ownership structure. What's really interesting here is who owns the stock. The top institutional ownership patterns. It says approximately 74% of Cidara is owned by sophisticated specialist life science investment funds. What does that tell you when you see that kind of concentration from such, seasoned players?
It's a huge vote of confidence. It really is. The list of the largest holders reads like a who's who of specialist biotech funds: RA Capital, VR Advisor, TCG Crossover, Adage Capital, BVF Inc., Bain Capital Life Sciences.
There's names in the space.
Exactly. These aren't just generalist funds. They have deep expertise in this sector. Their presence and the fact they participated in Cidara's financing rounds provides really strong external validation. It signals high conviction in the company's strategy and its science. You can bet they've done their due diligence.
Right. Now, insider holdings are reported at 1.38%. That might seem small on the surface, but here's where it gets really interesting. Director Krisa Minio made open market purchases, bought 3,320 shares on June 2nd and 3rd. That's just weeks before this pivotal data release. That feels like a powerful bullish signal, doesn't it? What does it communicate when an insider buys shares right before potentially make-or-break news?
It's a very strong signal. Yeah, it communicates that someone with intimate, non-public knowledge, or at least very deep insight into the company and its prospects, had high conviction in a positive outcome. Insiders rarely buy stock in the open market like that unless they genuinely believe the stock is undervalued or poised for significant upside. It certainly suggests they had a strong belief that these trial results were going to be good.
Powerful indeed.
Now, this ownership is quite concentrated. The top 6 funds, together, they control over 44% of the shares. So theoretically, large sales from 1 or 2 of them could put pressure on the stock price if they decided to exit. But in the current context, with this really positive data, this concentration probably offers more stability and support for management's long-term vision. These funds are likely in it for the long haul now.
Okay, makes sense.
All right, let's now delve into Chapter 6, Risk Assessment. We'll break this down using a classic SWOT analysis, starting with the company's strengths.
Okay, strengths. First and foremost, and arguably the most important now, is S1, clinically validated lead asset. That unprecedented positive phase 2b Navigate data for CD388, high efficacy, clean safety, it just profoundly de-risks the asset. That's huge.
Absolutely massive.
Second, S2, differentiated and proprietary platform. Their CloudBreak DFC platform is now validated by this success, offering future growth pathways. They have that CBO 421 ontology candidate too. And third, S3, visionary and proven management team, led by Dr. Jeffrey Stein. They have that track record of successful drug development and, as we discussed, really smart strategic execution.
Yeah, those are strong pillars. And let's add S4. Fortune's balance sheet, they're well capitalized, right? $174.5 million cash, essentially no debt as of March 31st, and S5, elite and committed investor base, backed by those top-tier specialist biotech funds we just talked about.
Okay, solid strengths. Now the flip side, weaknesses.
Right. Perhaps the most significant is W1, binary asset risk. The company's valuation is overwhelmingly dependent on this one single product, CD388. Any future setbacks, maybe in phase 3, maybe regulatory, however unlikely they might seem now after this data, would be severe.
Very dependent on one horse.
Pretty much. Second, W2, high cash burn rate. They're pre-revenue running expensive late-stage trials. That Q1 2025 net loss was $23.5 million, and that's expected to go up as phase 3 ramps up.
Which leads right into the next one.
Exactly. W3, inevitable future shareholder dilution. They will almost certainly need to raise more capital down the road. Phase 3 trials are incredibly expensive, and then there's potential commercialization costs. That likely means issuing more shares, which dilutes the ownership stake of existing shareholders.
Okay, and one more. W4, lack of commercial infrastructure. They don't have their own internal sales force, marketing, distribution capabilities yet. They'll either need to build that out, which is very costly, or find a commercial partner.
Correct. That's a big hurdle between trial success and actual sales.
Okay, let's move to opportunities. The biggest one seems pretty clear. O1, transform a multi-billion-dollar market. They have the potential to create and maybe even dominate a whole new market category for long-acting influenza prevention.
It's a massive opportunity, and it directly addresses O2, a major unmet medical need, providing a potential new standard of care, especially for those high-risk populations, elderly, immunocompromised who need better options.
And thirdly, O3, platform validation and expansion. CD388's success is crucial because it validates the entire cloud-break DFC technology. That paves the way for their future programs, like the oncology pipeline. Shows the platform works.
Exactly. It's not just about this one drug, potentially.
Yeah.
And finally, O4, prime mergers and acquisitions M&A candidate. A de-risked late-stage asset like CD388 with this kind of data, it becomes very attractive to large pharmaceutical companies looking to bolster their pipelines.
Makes them a target. Okay, lastly, the threats.
The primary one has to be T1.
Yeah.
Intense and well-funded competition. We mentioned GSK, Moderna. These are giants. They have far greater financial resources, established global infrastructure, huge R&D budgets. They won't just roll over.
Serious competition.
Definitely. Second, there's always T2, clinical and regulatory execution risk. Despite this fantastic Phase 2b data, Phase 3 trials are larger, more complex, often uncover unexpected issues. And the final FDA decision, while looking more positive now, is never guaranteed until it happens. Setbacks are always possible.
Never count your chickens before they hatch in biotech.
You got it. Then there are broader T3, macroeconomic headwinds, particularly around interest rates. Higher rates make future financing more expensive for companies like Cidara that aren't yet profitable. Though on the flip side, while things like trade tariffs probably have low direct impact, that global focus on pandemic preparedness we mentioned earlier, that's a significant tailwind. It could lead to government funding, strategic stockpiling agreements. That's a potential positive external factor.
Interesting balance of threats and opportunities. Okay, let's bring it all together. Chapter 7, conclusion. So, synthesizing all this, what are the key bullish takeaways for you from this deep dive? For me, it's that unprecedented 76.1% efficacy of CD388 that really de-risks the asset significantly. Its unique passive immunity mechanism seems like a potential paradigm shift, addressing a clear multi-billion-dollar unmet need. You've got the visionary management team pulling off that brilliant strategic pivot, the fortress-like balance sheet provides stability, and the backing of those elite specialist investors adds credibility.
I agree with all that. Those are the core bullish points. On the flip side, the key bearish points are still very real. There's that high-risk, single drug dependence. Significant hurdles still remain. Executing a massive Phase 3 trial flawlessly, navigating the FDA approval process, and then the huge challenge of commercialization, either building it or partnering smartly. The competition is intense and well-funded. The cash burn rate remains high, and future shareholder dilution is pretty much inevitable for a company at this stage needing more capital.
Right. And our educational DCF model exercise, with the assumptions we outlined back in Chapter 3, it suggested a wide but potentially compelling range of intrinsic values. It seemed to align with where Wall Street analysts were heading, indicating that even after this initial price surge, there might still be significant long-term upside, and it's a big if, the company continues to execute perfectly.
Exactly. I think Cidara's investment profile has fundamentally transformed. It's moved from being highly speculative to now being late-stage and, importantly, clinically de-risked to a significant degree. That initial stock surge to $22.67 clearly reflects this crucial shift. But you could argue the current market cap still might not fully capture the long-term value creation potential if CD388 reaches its full market potential. The whole investment proposition has really shifted, hasn't it? It's less of a pure bet on scientific discovery now, and more of a quantifiable bet on late-stage clinical execution and eventual commercial success. That's a substantially more favorable risk profile than before this data came out.
A very different company today than it was last week, it sounds like.
Fundamentally, yes. Which leaves us with maybe a final provocative thought for you, the listener. Considering this deep dive, how might a single annual injection, proven this effective against all significant flu strains, actually reshape global public health strategies? And what implications does that have for the future preventative medicine, maybe even beyond just influenza?
A lot to think about there, for sure. Great question to ponder. Don't forget to like and subscribe to the Stock Analytics AI YouTube channel. Remember, our 4.99-month members get priority deep dives on specific tickers you request. And keep an eye out over the next few months. We're covering all of the S&P 500 stocks with exclusive priority access for members.
And the necessary disclaimer. This analysis was generated by an AI system for educational purposes only and should not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.